Hey folks, my name is Eric Wilkinson. Yeah, you might recognize me from CNBC or other mainstream media for my commentary on everything from economic to geopolitical and market analysis. But what I'm here to do is to teach you guys different ways to trade option strategies and or implement that stuff into your portfolios. Anyway, remember, past performance of any trading system or methodology is not necessarily indicative of future results. All right, with that out of the way, let's get it on. Sorry I missed you guys for the last couple of days, 2 days in a row. I haven't actually done anything with my portfolio other than monitor it because I didn't want you guys to miss out on it. What happened was I took my computer, we went over to California. A lot of times here in Arizona when the heat gets above about 115, people like to flee the city, which is exactly what we did. And I usually, even when I go on vacation, bring my computer with me because as a trader, we aren't taking positions off during our vacation, so I might as well talk to you guys and keep you guys informed as to what I'm doing on those types of situations. And besides the fact that when you're a trader, you're constantly in the market, so we never stop working, right? But having said that, something was going wrong with my computer and I couldn't get it to boot up the last couple of days, or my laptop, I should say. So missed out on the opportunity. I was monitoring everything from my phone, which is another beauty in this digital world that we're in. All right, so with that said, I'm going to talk about a couple of economic data points that we might have missed yesterday. And really all we missed out on was the crude oil inventories. It was expected to be a drawdown of 1.4 million barrels, and you probably are already up to this. It was a drawdown of 2.7 million barrels, so a little bit better than 1.5 million or 1.25 million barrels more than expected on that drawdown. We also got the FOMC minutes, which really didn't say a whole lot other than that we're trying to work on this global recovery. Now, here in the United States, we aren't seeing a recession. And if you're following me on Twitter, I'm the one that's out there saying I don't see an issue here in the United States now. At the end of the day, we've got the yield curve inversion that was going on and that is a signal of recessionary aspects going forward. But we're not seeing that show up in the economic data. Across the pond, a little bit of a different story. So let's get on with the economic data there. We got the European French Flash Services PMI coming in at 53.2 or 53.3, expected to be 52.5. Last month's number then revised up slightly to 52.6, so about 4 tenths higher. Then we also got German Flash Manufacturing PMI. Now this is the one that's going to be the manufacturing aspect of the European area is really what we're looking at because that's where we've been seeing the signs of weakness. But with the German Flash Manufacturing PMI, it came in at 43.6, expected to be 43.1. As a matter of fact, it was better than the expectation. But what we are really concerned about here with this economic data point, I don't really care a whole lot about what their expectations on that number are. We need to see the line of delineation above and below 50 on these numbers. Anything above 50 is expansion, anything below 50 is contraction. And if you start getting 3 of these in a row, that is the signal that we are in a recessionary situation. And that being said, we've seen several of German's manufacturing numbers coming in basically for the last 6 months below that 50 threshold. So definitely seeing a recession in Germany, despite the fact that the Flash Services PMI for Great Britain has been above 50 consistently. We haven't really seen that dip for several years now below 50, but 54.4, expected to be 54.1. Not showing recession on the service aspect, but that German and French manufacturing sector is the biggest manufacturing areas of the European region. So when we're seeing those recessionary signs, it is not good for the global or for the European region. But that's part of the reason why we were starting to lower our interest rates here is the signals of a recession over in Europe could start leaching into the United States. So getting ahead of it to try and lower interest rates. And then we got the German Flash Services PMI coming in at 54.4. I think I just said that one. Rest of the European region, we got the flash manufacturing PMI coming in at 47. Expected to be 46.3. Again, better than expected there, but below 50, which is still recessionary signs there. And we've seen that number be below 50 for the last 6 months, almost as long as Germany. So it's really pulling down the whole curve there. And then the services PMI for the greater European region came in at 53.4, expected to be 53, so slightly above what was expected. But all we're really super concerned about here is that it being above or below 50 at this point. And then we move over here to the United States, and we got our unemployment claims, initial unemployment claims coming in at 209,000. That's lower than the expected 217,000. So the idea here is when people aren't claiming for unemployment, it is assumed that they have found a job or are content with their job. Flash manufacturing here in the United States, which isn't our most important economic data point. We usually look at the PMI, but this still gives us a decent gauge. It is the first time we've seen that number really dip below 50, and we got 49.9, expected to be 50.5. Last month's number was revised up from 50 to 50.4. So as long as it stays above 50, that's good. But this is the first time that we've seen the PMI number dip below 50. But again, we are more concerned about our ISM numbers. Those are the most important numbers that we're going to be looking at for our economic data point on PMI, which is Purchasing Managers Index. Most important economic data point of the month as far as I'm concerned, because PMI gives us a forward guidance as to what the economy is doing, because the purchasing managers are the ones that are going to be buying the inputs to the manufacturing process, and it is a gauge of their outlook going forward. So very forward looking, and that's what we want to keep our eyes on there. And we have the Jackson Hole Symposium going on, which really could move some markets. Finally, we got the natural gas storages coming in at 59 billion cubic feet, slightly higher than the expected 57 billion cubic feet. All right, and that's about it. Flash PMI, flash services PMI for the United States came in above 50 as well, slightly lower than what was expected, but still showing expansion. Again, we're going to be looking for our ISM, Institute for Supply Management, for our leading economic indicator. All right, moving on to crude oil futures. Coming off a little bit yesterday, we did see that drawdown that should drive prices higher, but we've talked about this. The market is stuck right here, right in and around the point of control, and anytime we have these points of control that are really kind of separated away from each other, we will have a tendency to see them try and build up a little bit in between. Somebody's going to win here, somebody's going to lose, but I believe that we're going to kind of fill this in and create a new point of control, because we've got the point of control right here for the volume, and the point of control up here is for the time. So anytime you have two separate POCs, those should end up aligning. I like to look at the volume a little bit more, because it is where the retailer or the institutional person is putting their money where their mouth is. All right, and right now we're right in between that, so we could definitely see some volume picking up in and around between, let's call it $57 a barrel and $53 a barrel. Okay, so we're seeing that happen right now. The overall market's really kind of not making major moves today. It's going to be hard to get crude oil to start driving higher, especially when we start coming into the fear of a recession. That's going to start pulling back on demand there. All right, moving on to gold. Gold pretty much unchanged. I mean, despite the fact that you guys didn't hear from me for a couple of days, you probably didn't lose much sleep, because the markets really haven't gone anywhere, as you can see here with gold. It's finding a lot of support at that $1,500 a troy ounce area. That should continue to act as support and resistance. We don't have anything lined up there with a Fibonacci or with the market profile, but the fact of the matter is that 1,500 gold has a tendency to really fall around those type of numbers where, 1200, 1500, those are big psychological levels that the markets like to try to defend, despite the fact that we can't really find a Fibonacci that is supporting that fact. It's more of a psychological level. All right, bonds coming off a little bit, but again, they haven't really gone anywhere as the markets were digesting the FOMC minutes yesterday, and therefore waiting for those coming in. But I've talked about this. I think we're at levels, despite I think bonds are a little bit priced too high for what I think is going to happen with interest rates, but we're starting to settle down in and around that. VIX getting a little bit of a move higher today, with the equities starting to look a little bit weaker this morning, but again, we are moving higher. I've got that directional move happening, so I was able to cover a lot of things in my portfolio. I got the direction right with the equities starting to move higher and feeling like the bonds were going to come off a little bit. But again, we are in and around the point of control, and I've talked about this for several weeks, and I'm sorry you guys have to keep hearing me say the same thing, but once we get this market where we've had those gyrations back and forth around that point of control, we got those big spikes where the markets were starting to try and drive directionality, but we've got that point of control really pulling them back home and creating a comfort zone there. So with that being said, we've got the Dow Jones slightly higher while the Nasdaq is a little bit lower now. Nasdaq though is stuck right there where we've been talking about. We've said that between this 78 Fibonacci there and the 50 Fibonacci right here, which is going to act as a bigger probably support, that the market would probably try to stay within this area and the point of control, drawing it like a magnet, okay? And that's exactly what's happening. Even though we're getting these big moves like the Nasdaq, a 50-point move in the Nasdaq is pretty big, and we've been seeing that go back and forth. It's really a battle of the bulls and the bears, but at the end of the day, we are at the point of control, so it doesn't really make me too concerned about what's happening on a day-to-day basis, up or down. We've got the E-mini S&Ps off by about 11 points right now, but again, we are stuck right in there. As soon as we get closer to the value area high up here, we start losing a little bit of that momentum as that point of control, this big red area here, starts drawing it back down like a magnet. And that's kind of what we're seeing today with the markets coming off a little bit. Then we go over to the E-mini S&Ps on the daily chart. This is a breakdown. Every candle is about a 30-minute chart. All of these blue is a full day session with the overnight, which is grayed out here. The darker black is the day session. So you can see coming into today, it was actually pretty flat, but we started seeing some weakness as soon as the market opened, tested those lows, and now we're starting to get a bit of a rebound. So all of this market has done is really started bouncing back and forth, and people are trying to pick a direction. And these were kind of the markets that would really chop up a day trader or somebody along those lines that has a shorter time frame, because they're trying to pick a direction and there's really no discernible direction at this point. So this is exactly what I've been talking about. That's the beauty in trading options, right? Is we can be directionally wrong and still make money, where these day traders are really getting chopped up right now. Chopped up like a Ginsu knife, huh? All right, so right now, seeing a little bit of a rebound off those lows in E-mini S&Ps, but I don't really expect the markets to have a major directional change right now. And with TLT coming off, I'm looking to cover this trade. Not quite out of the woods yet with this trade, because I've gotten that volatility expansion happening since I put that trade on. Now we're starting to see that directional move. You can see that those short calls were in the money. I'm out of the money now, but need some more volatility and a little bit more directional move to the downside. Again, I don't expect the markets to stay at this elevated level for the bonds, the 10-year and all of that. I think that we're priced in a little bit too much, and really could see some good information coming out of the Jackson Hole Symposium today. So I'm working to get out of TLT. FedEx is a trade that I have covered today. Was able to get out of this one for just a slight profit. Remember, when I put on this trade, I told you guys I made a mistake. I put this trade on in and around earnings. I didn't expect volatility to come out. As you can see, it's not come out. But, you know, the directional move sideways, we've gotten some theta decay. So I was able to get out for very close to a stretch. Actually, it was a slight winner, but as far as I'm concerned, it was basically a scratch to cover my my commissions on that trade. So I was in there and sold these September 145 puts. You can see today starting to come off a little bit, but short those 145 puts in FedEx. And I originally sold those for the FedEx trade. I originally sold for $1.84, and I was able to buy those back for $1.65. With all the commissions and everything else, it might have been a slight profit there, but just looking to get out for a scratch there. Now with SPY is another one that we had on for the directional assumption. I went in and sold the September 270 puts in there because remember, I'm expecting equities to move higher, bonds to move lower. Today we're starting to get a little bit of a pullback there, but it was well over a 50% of max profit. As a matter of fact, I saw that happening the last couple of days, but I wanted to make sure you guys could participate in this and follow along. So I went on those September 270 puts that I originally sold for about $1.20. I was able to buy those back for 67 cents. I think it was actually $1.22 on those, and able to cover those back for a decent profit, better than 50% of my max profit. So maybe sometimes it's a blessing in disguise when those kind of things happen with say your computer breaking down. And then IBM is finally the last one that we have here. And in IBM I had on the September was short the 125 puts in there. Again, we talked about this for the support here. 125 puts plus the commission that I was able to, or the premium that I was able to collect for that, put my break even just slightly below the 61 Fibonacci, which is usually where we see a lot of people come in and see some buying pressure. So that's why I was able to get that strike location and take advantage of that for that trade. And with IBM, it was basically getting out for 50% of my max profit. Volatility is kind of held on and haven't gotten a great directional move in my favor. So in those, I had on the September 125 puts, like I said, that I originally sold for about $1.22 and was able to buy those back for 60 cents this morning. So better than 50% of my max profit on that one as well. And those SPY trades, I think I confused that. Said I was short at 120, but it was actually much more like 180 or something like that. I'll have to double check of what my position was for that trade. As a matter of fact, I'll try and pull that up right now and see if I can get up that SPY before we get out of here. Make sure I get the right pricing on that. Actually, with this SPY that I sold at those 270 puts, I sold those for $2.01. Was able to buy them back for 67 cents this morning. So much better than 50% of max profit. All right, so that's about it. Today we're doing a webinar on the strangle. That's going to be a great one. If you expect a big outpaced move, we're starting to settle down. We're getting caught in this little range. Now, at that kind of situation, this is where I like to put on these types of trades, where we start to see volatility come out of some of these markets, gotten a little bit of complacency in it. Well, that's the time to be a bit of a contrarian when you're trading options. So check that out at Pro Trader Strategies. I hope you guys can all make it. And if you can't take that, take it easy.